Hi and welcome to Swissquote's Daily Market Talk. It's Monday, 25th of August. Powell wildly opened the door for a 25 basis point cut on Friday for September, and the dovish winds pushed global equity indices higher on Friday. Chinese equities climbed to a year high this morning, helped by local chip makers, a movement that wanes optimism about Nvidia's business potential there. But anyway, Nvidia will be announcing its last quarter earnings on Wednesday after the bell, and US GDP and PC updates and the European inflation numbers will be the major talking points of this week. So naturally, we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So investors lapped up Jerome Powell's words like honey on Friday, as the man has apparently been troubled enough by the latest weakness that he saw in the US jobs numbers to say that this situation suggests that downside risks to employment are rising in the US, and that if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. And obviously, no one wants that to happen, especially after very heavy criticism from the White House pointing at Jerome Powell as Mr. Too late, also thinking about the inflation turn that he missed after the COVID shutdown. So Powell basically delivered the 25 basis point before the September meeting itself, unless we see a major positive surprise in the next jobs figures from the US or a major quickening in inflation numbers. For example, September will probably bring the first rate cut since last September's 50 basis point cut, and nothing. Then the data, especially the inflation data, will tell if there could be further rate cuts on the wire into the year end. But let's eat just one lion at a time. For now, for the time being, markets and investors are happy. Risk investors especially got the best of what they actually wished from this Jackson's Hole speech and more, and Thursday's US GDP update and Friday's PCE data, which remember is the Fed's favorite gauge of inflation, will be, well, the major first test to that new dovish outlook from the Fed. So the second quarter GDP from the US is expected to print a 3% rebound in the US growth, following a dip that we saw a quarter before due to the tariff-led disruption, remember, where imports toward the United States had exploded before tariffs became effective, dampening the growth figure there. So we will probably see that readjust. So it's not going to be a major jump, mind you, but whether a strong GDP and potentially strong inflation data will derail the dovish Fed expectations is yet to be seen, because Jerome Powell's message on Friday was just too clear to be questioned regarding a September action, which is now almost fully priced in. So with a dovish policy shift in hand, the door is now wide open to fresh positive pressure across the global equity markets. As such, the S&P 500 jumped 1.5% on Friday and closed the week a touch below its all-time high level, while small cap stocks in the US, which needed lower rates more than anyone else, soared nearly 4% after Powell's dovish speech. Mood across Asian markets is positive. Gains in Chinese equities accelerate, with the CSI 300 index now hitting an almost one-year high level. But the story in China is not only about the Fed and the dovish Fed shift, but also an expectation that the Chinese authorities will be announcing more stimulus measures to strengthen appetite there. And we also have this rising appetite for Chinese chip stocks on news that DeepSeek, the Chinese AI company, will replace its Nvidia chips by local players' chips, as the Chinese government doesn't want the Chinese companies to keep buying American chips for national security reasons. And we also have related news on the wire that Nvidia actually did ask several of its suppliers to stop working on H20 chips, which are designed specifically for China. As such, the SMIC, which is seen as the equivalent of Nvidia for Chinese chip industry, jumped more than 10% on Friday's trading session and hit a fresh record high again today in China before pulling back. And Cameron Technologies rocketed 20% on Friday and hit the daily trade barrier to stop his gains and pushed to a fresh record high again today before pulling back. The stock price here is up by around 150% since mid-July. And as per Nvidia, it was kind of stayed by the dovish Fed expectations on Friday, and the company will be closing the earnings dance by releasing a second quarter earnings this Wednesday after the bell. So every tech investors around the world is watching how Nvidia performed last quarter with Chinese business in limbo and the rising competition, especially from the Chinese peers. So the company had pointed at a 45 billion US dollar in revenue for the second quarter of this year, plus or minus 2%, with margins sitting above the 70% mark. So that is pretty much the average consensus among investors out there. So if this is achieved, that would mean a 50% growth year over year, which is very, very strong, mind you, but it is also probably already priced in the market prices. Last week alone, bank analysts from big banks actually rose their price targets for Nvidia by more than 3%. So it gets me thinking maybe, but just maybe, Nvidia needs to take a breather at the current levels, and the rising competition from China, for example, could eventually eat into the AI optimism for US companies. But frankly speaking, though, if risk appetite remains this strong, thanks to the Fed, for example, and it looks like it will be, unless we see very, very disappointing numbers from Nvidia on Wednesday, which seems unlikely right now as well, investors will probably be rushing to buy the dips if there is any price pullback in the AI names. Now, coming back to the overall markets, US futures are near flat this morning, and they will probably be digesting Friday's positive news and gains, while European futures are looking slightly bearish at the time I'm talking here before the market open, as we are still waiting to hear more details about the Ukraine peace talks, and the peace pricing is losing momentum, mind you, due to the slow progress on that end. UK's market will be closed today for bank holiday, and note that the European markets also reacted positively to the Fed news on Friday by gaining across the board, as the dovish shift there comes at a perfect time, because it comes at a time that the European Central Bank itself is considering to pose its own interest rate cuts. Chic thought investors on Friday the Fed couldn't come to spice up things at a better moment. But there are still two factors that actually keep the European investors from fully enjoying the positive echoes from the Federal Reserve. First, well, is obviously the lack of progress, as I said, on the Ukrainian front. That could go both ways, really. And second, the fact that the rotation that we've been seeing from the technology stocks in the US toward other pockets of the market will probably stall, as lower borrowing costs from the Fed will probably have a positive impact on growth stocks valuations, and technology stocks will then benefit from the lower borrowing costs moving forward. So the next few days or weeks could eventually see the European indices underperform their US peers on depricing of the peace optimism and a possible U-turn on technology rotation. Major euro area nations will start revealing their preliminary inflation figures by the end of this week, so figures could maybe help lifting sentiment there. Appetite remains strong still, it's just that the potential may not be as high as before the Fed decision. In the metals and energy space, gold traded above its 50-day moving average despite Friday's risk-on rally, while US crude is stabilizing following 3 straight sessions of recovery. Resistance here is seen into the $64.75 to $65 per barrel range, including the 100-day moving average and a major Fibonacci retracement on this year's price action. Short-term risk in crude are two-sided today, while medium to long-term outlook remains cautiously bearish. In the bond space, joy, oh joy, the US 2-year yield tanked after Jerome Powell's dovish speech on Friday, and the US dollar slipped below its 50-day moving average, reversing last week's losses against majors like the euro, for example. The convergence due to a more dovish Federal Reserve outlook versus a established European Central Bank view should actually give a further support to the euro dollar, bringing a further rise toward the 120 level back on the table. So this is all for this Monday. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow and until then, good day trading.